I'm Lee Pacchia, and you are watching Behind the Headlines. Today we're wondering if there are signs of life in M&A. My guest says that we're at the beginning of a wave of activity that will take us through the new year. The news should bring much relief to transactional attorneys who have seen really low demand for their services since the middle of 2012. I'm joined now by Bill Lawlor, partner at Dechert LLP. He joins us coming up from Philadelphia. Welcome.
Good afternoon, Lee.
Thanks for taking the trip up to see us.
No problem.
So what's happening out there? It seems like things aren't quite as bad as they were, say, 4 weeks ago.
No, Lee, hope springs eternal for M&A attorneys, and it's true over the last year or two we've had some rough patches, but I see three waves that are hitting the M&A space, one short-term, one medium, and one long-term. Real quickly, the short-term wave, and we're seeing it right now, is in the tax area. As you know, the Bush tax cuts are set to expire. Capital gains rates going from 15 to 23.8 for the highest wealth individuals. Dividend rates are even worse. They're going to go from 15% up to 43 and change for the highest wealth individuals. And at the margins, those are creating deals. And if they're not
are any of these deals public yet?
Yeah, a lot of them are in the, I would say, middle market and in the family-owned space because of the individual tax rates being very sensitive. But in addition to just M&A, we're seeing a lot of dividend recaps.
Okay.
And there's a lineup there. Most of them are not public right now, but I think you'll be seeing one after the other. In our office alone, which handles about 50% strategic and 50% private equity. The private equity sponsored portfolio companies, a tax attorney in our office was saying he's working on 7 at the same time. So out of those 7, I would think a hit rate of at least half to 2/3 is going to come through by the end of the year.
And what are you looking at on the longer term? Where are things heading?
Well, in the medium space, it's the fiscal cliff, of course. I like to tell clients and media in interviews that technicals in the M&A space are overrated in relation to just CEO confidence. And when CEOs see an unpredictable climate, they step back, which is why you've got over $1 trillion of cash sitting on.
Yeah, I would imagine this would just kill deals.
Absolutely, you know? and both from a legislative standpoint and just a confidence and predictability of the future. If President Obama and Congress can figure out a way to get through this fiscal cliff, and I think they will, that's going to be a real shot in the arm in the C-suite in terms of what they see as a predictable future.
So it's almost like a slingshot effect. Everyone's kind of holding back deals that they'll be making in the normal course of business. And then once they kind of get past that uncertain point in time, then everyone's just going to have at it.
No question. And the third and longer term wave is you've got a powder keg in terms of M&A technicals. So you've got, as I mentioned before, this logjam of cash on corporate books, which if the CEOs don't spend it, Joe Hedge Fund is going to make them spend it, and they know they're knocking at the door. You've got PE ratios, which are in the mid-13s now. Historically, they've been 18, 19. You've got tax rates, which are now going to be predictable, high but predictable. You've got a regulatory climate, which is predictable. All these factors, private equity alone, they've got 2 tugs at them. On the one hand, many of these funds were set up in the boom years of 2005, 2006, and their investments have now reached the 5 to 6 year maturity level. Some people say there are over 2,500 portfolio companies just lined up at the gate ready to be sold. That's well over $1 trillion. And then on the other side, they've got low interest rates, historically low rates. Now's the time
which are going to continue
buy.
For a long time, probably 2 years.
2 years, but you know, with QE, whatever we're into now, inflation is sometime going to raise its ugly head, which is why people would rather strike sooner rather than later.
When you look at this from a 35,000-foot perspective, are there any industries or sectors that jump out at you in terms of areas that are primed for more M&A activity?
Well, I like to think it's funny, Lee. A lot of people ask, and I think they look at it too sector specific. I look at M&A catalysts as being a real mosaic of just chance encounters. I mean, if you look at sectors, look for dislocation, legislative dislocation, Dodd-Frank. The Dodd-Frank, for instance, in the bank area where there's capital ratio conservative increases. You've got banks that aren't permitted to buy non-banks, et cetera. These types of dislocations, even though they're not intentionally designed to increase M&A, can create the regulatory arbitrage to provide a catalyst. But just to give you an example of how arbitrary it can be, on my desk right now, I've got one hedge fund deal where they want to do a hostile offer to try to put together 2 defense contractors. I've got one multi-international company in the later stages of a multi-billion-dollar deal for where they have cash on the sidelines overseas, which because of our inefficient corporate tax code, a lot of multinationals have this trapped cash overseas they can't bring back tax efficiently. So they're going to spend that money on a company overseas who's the seller, private equity guy who's been sitting on this target for many years, and they're seeing their IRR go down as they sit on it. So you see this combination, you don't always predict it, but from either direction arbitrarily coming together.
In terms of business development and M&A, what keeps you up at night? What's the biggest thing out there that could really slow down the amount of work that you see coming in the doors at Dechert?
I see it as unpredictability. And what causes unpredictability? Blow up in Europe again. As much as we're hearing good things out of Washington, the fiscal cliff turns out to be a much bigger problem than we think it is. That and that alone. I mean, eventually, some of these technicals, like I mentioned on the excess cash and the private equity demands, et cetera, are going to have to push deals. But give me CEO confidence, and that really hinges on overall predictability.
It's been a constant drumbeat we've been hearing. Another theme that we've talked about a lot on the show is fee structures for various different types of departments in big law. How are things out there in M&A these days? Are clients more inclined to pay on an hourly basis, success fee, flat fee? Are things changing? I mean, we constantly hear about how lawyers are getting paid in very, very different ways these days than they were, say, 10, 20 years ago. Have you seen any fluctuation in your space at all?
Absolutely. That's a terrific question, too, Lee. I mean, we devote, starting 3 or 4 years ago when corporate America really started tightening its belts, we devote an extensive amount of resources to just project management on tracking fees and whatnot, because we find that many clients want very steep discounts to the hourly rate. We're better off, frankly, and I try to sell fixed fee deals, like an investment banker. A client really doesn't know how long it takes to draft an M&A document or prepare a prospectus. Steep discounts reduce our return out of the get-go and don't really deal with efficiencies. If I get a fixed fee and I can manage the deal well, then I come out ahead. The client comes out ahead because of the predictability of cost. Unfortunately, I must say that while some clients entertain fixed fees and alternative fee arrangements, they're called, many just use it as a stalking horse to try to get you to reduce your hourly rate, and that's unfortunate because I think ultimately we should do away with the hourly rate and go, at least in the M&A space, to something on a more fixed fee basis.
Sounds like it's a work in progress.
Absolutely.
All right, Bill Lawlor, partner at Dechert. Thank you so much for coming by today.
A pleasure.
If you'd like to learn more about the cases and issues we just discussed, be sure to go check out our offerings on BloombergLaw.com and also on our Bloomberg terminal. You can follow our updates on Twitter and see more of our videos on YouTube. I'm Lee Pacchia. Thanks for watching. Cool.
Good.
Yeah.
Thank you for having me.